Homeowners and soon to be homeowners, have you heard about the homeowners insurance crisis in California? If not, don't be caught off guard like so many today that are in panic mode. Brooks and I have received calls, emails, and texts regarding the growing number of homeowners receiving letters from their current insurers stating they will not be renewing their homeowners insurance policy. This insurance crisis is only growing more dire as insurance companies continue to leave California. Why is this? What can homeowners do? And what questions should you be asking? This video will provide you with information you need to know. From an insurance industry veteran, he will help us break things down in an easy to digest format so you're better prepared to obtain the right policy to protect your assets. Stay tuned. You don't want to miss this video. It's Christopher Marr with MMG Real Estate Advisors, and I've been selling real estate in Orange County and surrounding counties for over 30 years. Brooks and I believe that confident real estate decisions are a direct result of how well-informed one is. Ready to raise your insurance IQ? Let's go. First, we would like to provide you with some information so you have a basic understanding of the insurance environment before we bring on our special guest. Many homeowners today find themselves having to decide between admitted and non-admitted insurers. It's important to understand what these terms mean. In the state of California, as in many other states, there are two types of insurers: admitted insurers and non-admitted insurers. These distinctions are important when it comes to homeowners insurance policies. It's critically important you understand these two types of insurers. Let's start first with an admitted insurer. Admitted insurers are insurance companies that have been licensed by the California Department of Insurance to sell insurance policies in the state. These insurers are subject to state regulations, oversight, and financial stability requirements. They must meet certain solvency and consumer protection standards. Policies offered by admitted insurers are typically considered more secure because they are backed by the California Insurance Guarantee Association, or CIGA. Now, CIGA is a safety net that helps policyholders in case their insurer becomes insolvent. Admitted insurers need to file their rates and policy forms with the California Department of Insurance, CDI, which ensures that their policies are in compliance with state laws and regulations. These insurers often participate in the California Fair Plan, which is a state-mandated insurance program designed to provide essential property insurance coverage to homeowners who have difficulty obtaining coverage through traditional insurers. Now, let's address non-admitted insurers. Non-admitted insurers, also known as surplus lines or excess and surplus line insurers, are not licensed by the California Department of Insurance to sell insurance in California. These insurers are not subject to the same level of regulatory oversight as admitted insurers. They are not part of CIGA safety net, so there may be more risk associated with policies from non-admitted insurers. Non-admitted insurers typically cater to customers with unique high risk or specialized insurance needs that cannot be adequately met by admitted insurers. These policies may be more flexible, but also come with potentially higher costs. When purchasing a policy from a non-admitted insurer, homeowners may be required to sign a broker of record letter acknowledging that the coverage is not guaranteed by the state's insurance guarantee fund. Homeowners may turn to non-admitted insurers when they have difficulty obtaining coverage through admitted insurers due to their unique circumstances, or if they need specific types of coverage not readily available through the standard market. We are fortunate today to have Kareem, a licensed insurance agent, to help provide some much needed clarity for homeowners in what is often referred to as the California insurance crisis. As realtors, Brooks and I are staunch advocates for home buyers and home sellers, and we're constantly striving to ensure our clients have the necessary knowledge to make informed, confident real estate decisions. Kareem, anything you would like to add about admitted and non-admitted insurers?
I couldn't have said it better myself. It's so important today for homeowners to understand the distinction between the two when considering their options. Admitted insurers typically offer greater consumer protection and financial stability, but non-admitted insurers can be a viable option for those with special insurance needs or challenging circumstances. Before choosing an insurer, I recommend homeowners should carefully review their policy and assess the company's financial stability and reputation.
These are the four main rating agencies: AM Best, Standard & Poor's, Moody's, and Fitch. We also have the links to these rating agencies in the description below. Now, there has been no shortage of headlines about all the insurance companies pulling out of California. I think it's important to understand that California is not the only state struggling with insurance availability and affordability. You mentioned the two main reasons, one being the new III issue brief and Proposition 13, which passed in 1988, and two, insurance companies' ability to be profitable. Now, this sounds like a 1-2 punch for the insurers and California homeowners. Can you elaborate a little more on the new III issue brief and Prop 103, since they appear to be the cause and profitability seems to be the effect?
Absolutely, and that's correct. III issues briefs are designed to provide timely snapshots of specific risk areas, as well as broader issues and trends. Instead of letting insurers use the most current data and advanced modeling technologies to inform pricing, Proposition 103 requires them to price coverage based on historical data alone. It also bars them from incorporating the cost of reinsurance into their prices. This problem is exacerbated by a 3-decades-old legislative measure that severely constrains insurers' ability to profitably insure property in the state. Insurers' underwriting profitability is measured using a combined ratio that represents the difference between claims and expenses insurers pay and the premiums they collect. A ratio below 100 represents an underwriting profit, and one above 100 represents a loss. Insurers have earned healthy underwriting profits on their homeowners insurance business in all but 2 of the 10 years, between the years of 2013 and 2022. However, the claims and expenses paid in 2017 and 2018, due largely to wildfire-related losses, were so extreme that average combined ratio for the period from 2013 through 2022 was 108.1. The respective combined ratios for 2017 and 2018 were 241.9 and 213.4.
Wow, that chart speaks volumes. I think many Californians simply saw it as 2 unfortunate years for insurers and not how deep those losses really went. Let's discuss underwriting and what is the process involved.
Underwriting profitability matters because this is where the money comes from to maintain the policyholder surplus. The funds insurers set aside to ensure that they can pay future claims. Integral to maintaining policyholder surplus is risk-based pricing, which means aligning underwriting and pricing with the cost of the risk being covered. Insurers hire teams of actuaries and data scientists to make sure pricing is tightly aligned with risk, and state regulators and lawmakers closely scrutinize insurers to make sure pricing is fair to policyholders. To accurately underwrite and price coverage, insurers must be able to set premium rates prospectively. As shown in the previous chart, 1 or 2 years that include major catastrophes can wipe out several years of underwriting profits, thereby contributing to the depletion of the policyholder surplus if rates are not raised.
So, as I understand it from what you've said, California is a large and potentially profitable market for insurers, but current loss trends and the constraints of Proposition 103 have caused several insurers to reassess their desire to write coverage, which is largely because of the wildfire losses combined with events like the early 2023 anomalous rains and more recently Hurricane Hilary. So clearly, there's an increased urgency for California to continue investing in risk reduction and resilience. Anything else you would like to add?
Correct. And let me add on a little bit more to that. California will also need to update its regulatory regime to remove impediments to underwriting. An effort in the state legislature to rectify some of the issues making California less attractive to insurers failed in September 2023. With fewer private insurance options available, more Californians are resorting to the state's FAIR Plan, which offers less coverage for a higher premium. The California FAIR Plan only covers a property for fire and nothing else. So no water loss coverage, no liability coverage. It's literally the last stop shop for homeowners insurance in the state of California.
Okay, so you say last stop shop for California homeowners. Can you explain the California FAIR Plan?
No problem at all. Let's take a dive into that. The California FAIR Plan is an insurance program designed to provide basic property insurance to individuals who are unable to provide coverage in the standard insurance market. It is intended for residents of California who are at risk of losing their home due to high-risk factors such as proximity to brush fire areas. The FAIR Plan is a last resort option for those who have been turned down for coverage by traditional insurers. While it offers essential property insurance, it may not provide as comprehensive coverage as standard policies, and it is generally more expensive. Homeowners can apply for coverage through the FAIR Plan if they meet certain criteria, and the coverage is typically limited to the dwelling and may not include additional features available in standard policies. It's important to note that the FAIR Plan is not a government program. Although it was created by a government official in 1968, the FAIR Plan is a private association whose day-to-day operations are controlled by insurance companies, not taxpayers.
Many homeowners aren't aware of the two types of homeowners insurance policies issued in California. Sad to say, most only learn the difference when they need to file a claim, and unfortunately then, it's way too late. Can you explain the difference between an HO3 and an HO5 policy? Also, if anyone wants more information on the other 6 types of homeowners policies, we will have a link in the description below.
First, let me just share how I appreciate you taking the time to create this content to help others. Home buyers and sellers will make better decisions because of it.
Well, Brooks and I appreciate that. Your expertise is critical to this video. While watching, if you find value in our real estate content, give it a thumbs up and hit the subscribe button if you want to be alerted to future videos. Let's jump back to the difference between an HO3 and an HO5 policy.
The two main types of homeowners insurance policies in California are HO3 and HO5 policies. While both insurances protect your home, there are key differences between the two that can influence your decision when purchasing a policy. Generally, HO5 insurance is considered the most comprehensive form of home insurance you can get, but it often comes at a higher cost than HO3 insurance. While HO5 insurance may seem tempting, HO3 insurance might suffice depending on your situation. Knowing the difference between the two is key just to get enough coverage and avoid being overinsured.
Okay, so what is the difference in coverage between HO3 and HO5?
Great question. The key difference between the HO3 and HO5 policies is personal property coverage. HO3 covers damages due to named perils, while HO5 cover all perils except those explicitly excluded from the policy. Additionally, HO3 policies cover the property's actual cash value, which accounts for depreciation, while HO5 policies cover replacement cost, replacing your item without regard for depreciation.
Okay, that's good to know. I heard you say the word peril. What is peril?
A peril refers to the causes or events that can result in damages to your home or personal belongings. There are two types of perils, named and open. Personal property coverage is the primary distinction between HO3 and HO5 policies. HO3 only include named perils, while HO5 excludes only explicitly mentioned perils. Both HO3 and HO5 policies typically provide open peril dwelling coverage, meaning Damages to the home are covered unless explicitly excluded. It's important to review the named perils with your insurance agent or broker.
Let's address ACV and RCV because I can see how there may be some confusion when a claim is paid out.
Great idea. HO3 policies reimburse personal property based on the actual cash value of the damaged property, considering depreciation, whereas HO5 policies reimburse based on the replacement cost value, ignoring that depreciation portion.
Okay. What would be the likely reasoning someone would choose an HO3 instead of an HO5 or vice versa?
Well, you'd want to choose an HO3 policy if you don't have much valuable personal property. While HO3 policies aren't quite as comprehensive as HO5, they still provide adequate coverage in many cases. If an HO5 policy isn't available where you live, you can also opt to include extra coverage with your HO3 policy for an additional cost. Choose an HO5 policy if you have a lot of valuable personal property and live in an area where coverage is available. They're often not as much more expensive than your typical HO3 policies and can help protect your property in a wide variety of situations.
Sounds like the cost of an HO5 insurance premium may be slightly higher, but it can help save you money in the long run. Do you have time for a few more questions that will help homeowners raise their real estate IQ?
Absolutely. As you and Brooks say, better informed begets better decisions.
What are the most common exclusions in California homeowners insurance?
The following exclusions are on the majority of homeowners policies. Things include flood, earthquake, earth movement, termites, vermin, slow water losses where a home's been vacant for more than 60 days, wear and tear or maintenance, war, insurrection, nuclear hazard. Ultimately, you're going to want to talk to either your agent or your broker and confirm what is actually excluded off the policy.
So tidal waves and nuclear hazards are not covered? I better go check my policy because that's going to keep me up tonight. Anyways, is it true that homeowners are finding themselves having to buy two separate insurance policies?
Yes, that's correct. If no carriers are willing to accept you, the last stop would be the California Fair Plan. Now, the California Fair Plan only covers for fire damage and nothing else. There's another policy called Difference in Conditions, DIC, or a wrap policy that covers water losses along with liability coverage. These two policies together are equal and comparable to a regular homeowner's policy.
What are the common mistakes homeowners have made when purchasing a homeowner's insurance policy?
The main thing I see is people not asking the right questions to the insurance company. Most people shop on price and not coverage. Some questions that I would personally ask in California is the dwelling covered under replacement costs or actual cash value? This makes a big difference on coverage and premium, as we mentioned beforehand. How are high value items like jewelry covered? How does liability extend? What are your exclusions? Do you guys cover animals? What endorsements do you carry, whether it be a backup of sewer or drain, building ordinance? Do I need workers' comp for my nanny? Do they cover wildfires? Do they cover smoke damage? If so, how much?
Those are good questions to ask. We'll put a link for some common questions to ask your insurance agent or broker in the description below. Does every insurer have 30 to 45 days after the policy goes into effect to inspect the home and potentially increase your premium?
Not every insurer does that, but I've seen it up to 90 days for an inspection. Most of the time there's an increase in premium. It's due to the dwelling amount being raised by the insurance company to adequately insure the property. Other reasons for a policy premium to be increased after the inspections are animals on the property, state of the home. You might have a bad roof, debris, etc. Trampolines. Some people are running daycare centers or some form of rehab homes when it's supposed to be something else entirely. These are all different factors that will increase your property insurance.
Well, Brooks and I appreciate your time. Any last pieces of advice before we wrap this up?
One thing I'd like to leave you with is that most homeowners will let me know right down to the penny of what they spend on homeowners insurance. And oftentimes they cannot tell me exactly what they're covered for. So I highly recommend that you reach out to your insurance agent or insurance broker and ask those questions in regards to the home policy.
Well, thanks for watching. If you have any questions about anything said in this video, feel free to drop us a comment or send us an email. We're here to help you navigate the home buying and home selling process and be a trusted resource you can rely on. If you feel there's someone you know who can benefit from this information, well then give it a share. And until next time, thanks for watching, and we'll see you in our next video.